I think that informs their recent moves, which basically are they've said that they will open, or at least the Shanghai Gold Exchange, which is completely under the control, incidentally, of the People's Bank of China. They've said that they will open a vault in Hong Kong, and they have also said that they will open a vault in Saudi Arabia. Why? Because Saudi exports a lot of oil to China. Saudis want to be able to trade yuan for gold and gold for yuan. I mean, quite obviously, because of their trade. And I think you may well see other vaults being opened. This is all part of the internationalization of the yuan. And then only, last week or 8 days ago or whatever, it was announced by the Shanghai Futures Exchange that they would open up the futures exchange in Shanghai to foreign participation. A foreign bank can deal on the Shanghai Futures Exchange at the moment, but it has to do it through a Chinese entity. That is all going to go. So, and this is obviously not just gold and silver, it's also base metals. There was the nickel problem, if you like, in London when a whole load of trades had to be cancelled by the London Metal Exchange. That was a bit over a year ago now. So they want to take control over all this, if you like, at least to their advantage. Now, I think that one of the points behind the internationalization, if you like, the mobilization of gold as part of a trading situation, if you like. I mean, trading not fixed at this stage to the yuan, but obviously trading alongside the yuan. At some stage, when the dollar really does start collapsing, I think you will find the Chinese are in a position to immediately announce a fixed exchange rate between the yuan and gold, in order to stop their own currency sliding along with the Western currencies, led by the dollar. This is all after President Trump's Liberation Day. I mean, bear in mind that the reaction from the Chinese was uncharacteristically quick. The first announcement that came out was that they were going to speed up the negotiations for a free trade agreement between China, Japan and South Korea. And then this was rapidly followed by President Xi visiting some of the leading ASEAN nations, which are basically the other nations, if you like, in Asia, in Eastern Asia. I mean, I think I can't remember, he went to Myanmar, he went to Vietnam, he went to Malaysia rather, and I think he went to Thailand as well. So now this was quick. Now I'm fairly sure that the conversations that he was having was really about very quickly establishing a plan B, if you like, when America, started raising all these tariffs, this tit for tat tariff sort of thing. China needed to protect herself. She needed to secure her regional market, if you like, and that's what that was all about. And so this move on gold, I think, is in some senses an extension of that. And I'm sure that President Xi would have said to some of the leaders in these ASEAN nations, we're quite happy to sponsor a gold vault so that we can trade in yuan and we can trade in gold, whatever you like. I mean, this would be particularly one of the countries he went to was Vietnam. Now, the Vietnamese do use gold for ordinary settlement. I mean, you buy a house in Vietnam, you use gold. So, you can see the links, if you like. I may be joining the dots too much, but to my mind, it is actually quite clear that there is a new world out there which we are not involved with, and it is based on Chinese yuan that will become the principal currency replacing the dollar. And at some stage, it will be guaranteed by gold. And that, I think, is very, very important to understand.
Well, it's really quite extraordinary if you step back and look at what's happening globally with respect to gold and indeed silver. I've said this for some time now, but it bears repeating. We are witnessing the quiet, methodical reordering of the world monetary system, and gold is right at the center of it. Most people in the West are completely oblivious, which is rather typical. The average chap is far too preoccupied with the stock market tickers, tech IPOs, and whatever new distraction Wall Street is cooking up to notice what central banks and major sovereign players are actually doing with real money, which of course is gold. Now let's focus on China for a moment, because China's moves here are absolutely pivotal. What they're doing is not some hastily cobbled together reaction to short-term noise. It's a strategic plan decades in the making. The People's Bank of China, through the Shanghai Gold Exchange, is not only the ultimate controller of the Chinese domestic gold market, but it's actively orchestrating the next phase of gold's international role. When they announced that they'd be opening a vault in Hong Kong under the Shanghai Gold Exchange umbrella, it was clear enough. But then the announcement that they'd also open a vault in Saudi Arabia, well, that, to my mind, was truly momentous. Why Saudi Arabia? It's quite simple. Energy. Saudi exports vast amounts of oil to China, and it is only logical for them to want the ability to transact oil in yuan, but critically, with the implicit guarantee that the yuan can be converted into gold if needed. This is precisely what gives a currency real weight. It's the same logic that underpinned the US dollar's ascendancy under Bretton Woods. Back then, the dollar was as good as gold because you could redeem dollars for gold at $35 an ounce. Today, China is engineering a mechanism that will allow oil exporters like the Saudis to effectively do the same with the yuan. Gold is settlement. It's quietly revolutionary. You might recall just recently, the Shanghai Futures Exchange announced that foreign participants would now be able to trade directly on their platform. Previously, if say JP Morgan or HSBC wanted to access Shanghai's futures markets, they had to set up shop via a Chinese intermediary. That's all changing. And it's not just gold and silver, it includes base metals like copper and nickel. And remember that fiasco in London about a year ago, with the LME nickel contracts being forcibly canceled because certain parties found themselves on the wrong side of a massive short squeeze. It thoroughly discredited the LME's reliability in many eyes. China is keen to position Shanghai as the alternative, the more trustworthy venue for actual delivery. It's a subtle but profound shift in pricing power. The West has long used its paper derivative markets in London and New York to dictate global metals prices. The actual metal flows often didn't matter as much as the leveraged contracts. But what we're seeing now is the East, and by that I principally mean China, systematically building the infrastructure to flip that dynamic. They're ensuring that price discovery moves to where the physical demand resides, and that means Shanghai, not New York or London. What does this imply down the line? Well, at some point, especially when the dollar enters a more visibly disorderly decline, China could very well announce that the yuan is explicitly tied to gold at a fixed ratio. Not today or tomorrow, mind you, but that's clearly on the long-term table. They've been steadily accumulating gold since at least the early 2000s. In fact, I've argued many times that the official PBOC gold reserve figure is vastly understated. Much of China's gold has been tucked away in separate accounts under the People's Liberation Army, the Communist Party youth organizations, and provincial funds. It's entirely plausible that China already has well over 20,000 tons of gold. So imagine this. The dollar begins to seriously falter under the weight of its own debt, which, by the way, is now over $34 trillion on balance sheet with far more off. Confidence erodes. China steps forward and says, the yuan is now backed by gold at X grams per yuan. They don't even need to make it fully convertible, merely credible. What does that do to the dollar? What does that do to global trade settlement? It's telling that one of the places Xi visited was Vietnam. In Vietnam, real estate transactions, buying a home, say, are often settled in gold. It's culturally normal there. You see, there's an entire parallel monetary infrastructure in the East that still has gold embedded in daily economic life. That is an enormous psychological and practical head start if you're planning to eventually tie a currency explicitly to gold.
China started off with this, when Mao Zedong died. This thought, if you like, was behind the appointment of the People's Bank of China to act not only for all the foreign exchange transactions, along with the SAFE fund, which is sort of seen as a sovereign wealth fund, which is underneath the control of the People's Bank of China. But also in 1983, regulations were produced by the Communist Party appointing the People's Bank with sole control over the nation's gold and silver programs. And it was clear that with that big bear market that we had between 1980 and, this started in 1983, in effect, between then and the year 2000, 2002, there was a lot of gold coming out on the market. These were the conditions under which the People's Bank of China was able to accumulate substantial, undeclared quantities of gold bullion. By 2002, obviously, the People's Bank of China and the Communist Party reckoned that they had got enough gold to secure their currency in the future. And so at that stage, they opened the Shanghai Gold Exchange and allowed ordinary Chinese citizens to accumulate gold. Until then, they'd been banned from owning it completely. Since then, Chinese have taken delivery out of the vaults, the SGE's vaults, of around about 27,000 tons. Some of that would have probably gone back in as scrap, because anything which is resubmitted to the vaults, if you like, is scrapped and then recast. But on top of that, there is quite a lot of gold which is actually owned by banks and also ETFs and other investment funds, which are stored within the Shanghai Gold Exchange's vaulting system. So we're looking at very substantial quantities of gold. And I reckon that by 2002, I reckon the state had probably accumulated around about 20,000 tons of gold. And also bear in mind that they invested a lot of time and effort into both refining gold and also mining gold. And they quite rapidly became the largest gold mining nation in the world. And have held that position for, 15 years now? It must be about 15 years. So, and the other thing is, of course, we've seen gold go from the west to the east. I mean, this was, a story which that's 20 years old, that story now. There's an awful lot of gold has gone into China. And not only that, but nothing comes out of China. I've spoken with directors of the Swiss refiners, asked if they ever see any Chinese refined bars, and the answer basically is no. There was a report of a few bars turning up, and it was thought that those were smuggled out. But, basically it's Hotel California for gold. So there's an awful lot of gold, both owned by the state, and also owned, and not declared as reserves, incidentally, owned by the state and also owned by Chinese nationals. So how much it comes to, I really don't know.
Now, picking up where we left off, let's press a bit further into what the likely consequences are of this massive global reordering. Because as I've argued often, the remonetization of gold is not a speculative possibility anymore. It's well underway. And while it may still take a few years to fully materialize, we're seeing every important signal flashing red that the world monetary system is in profound transition. Let's circle back for a moment to the concept of the yuan eventually being pegged to gold. It's very clear to me that the Chinese leadership is preparing precisely for that contingency. And when that moment comes, it won't be about them wanting to do it. It will be a necessity to preserve confidence in their own currency if, or rather when, the dollar undergoes a more spectacular crisis of confidence. Consider what would happen if China suddenly revealed it holds, say, 25,000 tons of gold, dwarfing the U.S. official 8,133 tons, which itself many question if it's still physically unencumbered. They could declare a gold peg overnight. Now imagine the shock that would ripple through the currency markets. That's not to say it's imminent. The Chinese strategy has always been to wait for the West to make the mistakes and then respond calmly and with maximum strategic leverage. It's what Sun Tzu would advocate after all. That's why these moves to open vaults in Hong Kong, in Saudi Arabia, perhaps in Singapore or even Vietnam down the line, are so significant. They're laying down the plumbing for global trade settlement, not just in the yuan, but critically in gold. That means when the day comes that the dollar can no longer reliably act as the global settlement medium, there's already an alternative system waiting in the wings. Let's not forget, it's not only China doing this. Russia is deeply intertwined here as well. Under the BRICS expansion, we're seeing moves to set up an inter-BRICS settlement system that by design circumvents the dollar and SWIFT. You've got the Eurasian Economic Union, the Shanghai Cooperation Organization. All of these interlocking trade alliances now discussing either gold-based settlement or at minimum digital accounting units tied to commodities with gold very much in the mix. Now, of course, there are still many who dismiss this. They say things like, oh, well, the dollar is still over 80% of global transactions. Yes, I mean today. But trends are far more important than snapshots. Look at the speed of change. 20 years ago, the euro was still a novelty, and China was barely registering on global trade metrics. Now the euro is dominant in European trade settlements. China is the largest trading partner for over 130 countries, and BRICS nations collectively exceed the G7 in GDP on a PPP basis. Even the IMF quietly admitted in a working paper last year that the global foreign exchange reserve composition is gradually shifting away from the dollar, with more diversification into gold and regional currencies. They tried to bury it in diplomatic language, but the data was there, and we're seeing hard confirmation. In 2023, global central banks bought over 1,100 tons of gold, the most on record, even exceeding the previous year, which was itself a post-Bretton Woods record. But what's the flip side of this? What does it mean for Western bond markets and stock markets, where the average investor still imagines all is well because the S&P 500 is near highs? Well, it's here that we come to what I believe is the most underappreciated risk. The world has funded U.S. deficits for decades by recycling trade surpluses into treasury bonds, the so-called exorbitant privilege. But if the dollar's reserve roll wanes, who exactly is going to buy the endless torrent of treasury issuance? We've already seen warning shots. Foreign official holdings of treasuries peaked back in 2014. Since then, the growth has flatlined and even reversed in key cases. China has reduced its holdings. Japan is treading water. Even Belgium and the Caribbean banking centers, which often warehouse Chinese and Middle Eastern money, have become net sellers at times. Meanwhile, the U.S. needs to issue $2 trillion plus every year just to cover the deficits, plus trillions more to roll over maturing debt. This brings us to the fragile foundation under U.S. markets, the assumption that bond yields will always remain low, but they only stay low if there's endless demand. And what we're seeing is a gradual erosion of that demand, coupled with a monumental supply tsunami. The result? A market that becomes more and more dependent on the Federal Reserve itself to buy the debt. That's a confidence game, and history shows us how those end. Think about the practical consequences. Higher Treasury yields push up mortgage rates, auto loans, credit card interest. Corporate borrowing costs rise, eating into profit margins. Eventually, bankruptcies spike. You can see this already starting in the commercial real estate sector, with office towers in places like San Francisco or New York City defaulting on billion-dollar loans. Bloomberg recently ran an entire feature on how $1.5 trillion in commercial real estate debt comes due by 2026, much of it locked in when rates were near zero. It simply won't refinance on viable terms. And don't overlook consumer debt. Americans now have over $1.13 trillion in credit card debt, the highest on record, with delinquencies rising sharply. The average interest rate? Over 21%. So you have a populace stretched thin, a corporate sector staring at debt walls, and a sovereign government that's addicted to borrowing. That's what we call a triple whammy. Now people might say, but Alasdair, the Fed will just cut rates again or print more money. Of course they will. That's precisely why you should worry. Because each new bout of printing erodes confidence further, driving more foreign central banks to accelerate their gold buying, pushing the global monetary order ever closer to that tipping point. It's a self-reinforcing cycle. Remember what happened in the 1970s after Nixon took the U.S. off gold? The initial hope was that closing the gold window would strengthen the dollar. Treasury Secretary John Connolly even famously told European finance ministers, "The dollar is our currency, but it's your problem." That arrogance didn't age well. Within a decade, the dollar lost over 60% of its purchasing power. Gold soared from $35 to $850. Oil prices rose tenfold, and it took Volcker hiking rates to 20% to finally arrest the collapse in confidence. But can you imagine the Fed raising rates to even 7% today, let alone 20%? It would detonate the U.S. deficit, interest on debt would triple, and instantly bankrupt half the economy. So instead, they're trapped in what I've often called a debt death spiral. The only way out is inflation. Now let's stitch all this together with what's happening in the gold and silver markets specifically, because here's where it gets even more interesting. You have record physical deliveries off the COMEX and LBMA. You have premiums in Asia, particularly Shanghai, running $50 to $60 over London spot prices, effectively arbitraging Western bullion out of vaults and into China. It's what Eric Jung and other seasoned metals traders have described. China deliberately suppressing paper prices in the West by going short on COMEX, while simultaneously buying up all the physical they can through Shanghai and bilateral deals. This is not speculation. It's visible in the customs data and warehouse drawdowns. The LBMA's vaults have lost over 1,500 tons of gold since 2021. The silver stocks are even more alarming, with registered COMEX silver at multi-decade lows. So when people ask me, is gold expensive at $3,300? Is silver pricey at $38? I usually laugh gently. No, gold isn't going up. Currencies are going down. Silver especially is still historically dirt cheap versus gold. The gold-silver ratio has been hovering around 85 to 1, when over 500 years of monetary history suggests it should be closer to 15 to 1. That's a five-fold upside for silver just to reach historical norms. We're also seeing a fascinating evolution in who buys gold. For the last 2 years, it's been overwhelmingly central banks and sophisticated institutions. Retail Western investors? Barely involved. They're too busy chasing Tesla or the latest crypto. In fact, the World Gold Council data shows Western ETF holdings are still down from their 2020 peaks. This is classic. The smart money accumulates quietly. Only later does the public pile in, pushing prices to manic peaks. And here's where we bring a little humor in. Someone tweeted recently, "The average millennial has $400 in the bank, but is giving financial advice on TikTok about why gold is outdated." Quite right. Meanwhile, Singapore, Poland, Turkey, China, and even India's central bank are scooping up every ounce they can. So what's an individual investor to do? I've long advised that you don't wait for the crowd to figure this out. You accumulate gold and silver now, while Western premiums are modest and before the inevitable public panic. Think of it as buying insurance when your house isn't yet on fire. When it is, the cost skyrockets, if you can even get it. To close, let's return to the grand picture. The monetary order that's governed the world since 1944 is unraveling. The dollar's days as unchallenged global reserve are numbered. Gold is reasserting itself not because it's changed, gold never changes, but because trust in fiat regimes is eroding. The Chinese understand this. The Russians understand this. The Saudis, the Brazilians, the Singaporeans, they all understand it. The only people who seem confused are the very same Western financial elites who chuckled at gold bugs for years. As Mark Twain is reputed to have said, history doesn't repeat, but it often rhymes, and the next rhyme will be unmistakable. Just like in the 1970s or the 1930s before that, when the dust settles, gold, and by extension, silver, will be at the very heart of the new system. So position yourself wisely, because when the monetary storm finally breaks over us, it won't be a gentle shower. It will be a deluge. And as ever, only those holding real money will stay truly dry.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.